Wow! The Bank of Canada cuts interest rates by 50 basis points for the fifth consecutive cut in a row to 3.25%. Now, this was the news that us Canadians woke up to this morning. I figured I'd come today and make a video explaining just interest rate cuts in general and what they mean for you as an investor and more so just as a human being living here in Canada. I have, by the way, done videos in the past solely on this topic if you care to go dive into more of the nuance and intricacies of things like the overnight rate and the bank rate and the deposit rate. Maybe you could go dig this up after this video if you're interested in learning more. But today, let's talk general. Let's talk high level and what's relevant for us today as beginners, starting with the question, what are interest rates in the first place? What are they good for and what are they used for? And if I were to just summarize in one simple sentence, we can think of interest rates as the cost of borrowing money, and they impact everything. And most of us Canadians at some point in our life will be involved in some sort of borrowing, whether that be a mortgage, whether that's a personal loan or some sort of general loan or line of credit, some type of borrowing. Interestingly, what a lot of people will overlook is that we often are on the flip side of that, and we actually do some of the lending when we buy fixed income style products, a debt style investment. If we buy a bond or a GIC or some sort of term deposit or some sort of vehicle where we are, the characteristic of that investment is that we're taking our hard-earned money and we are lending that. We're lending that to the government or to a corporation or to a bank for a fixed term. We're earning interest, right? When you earn interest on a high-interest savings account, that's what's happening. You're lending your money to a bank. They're paying you interest to use your money, and then you can get that back at the end of the term or date or et cetera, et cetera. So we play both sides. We play the borrower. Sometimes, depending on our investments, we play the lender. And interest rates impact that cost of borrowing. It could be in our favor sometimes, and sometimes it can be not in our favor. Now, I want us to think more importantly beyond just the personal side of things. So like our mortgage or our line of credit. In our economy, you have these massive companies and corporations who also play by these same rules. And let's picture, for instance, a big real estate developer, right? This is a company, a corporation who spends millions and millions of dollars working on a new project and sourcing a bunch of material and hiring a bunch of people. They have all these costs. Well, when interest rates are, let's say, high, when interest rates go up and up and up, meaning the cost of borrowing money has increased, it costs more to get access to this same amount of money that they want to borrow from the bank. Well, what that does is that it is almost discouraging. It's less attractive to go out and borrow money to invest and borrow money to spend and consume when rates are higher and the cost of borrowing has gone up. Actually, what happens too is that when rates are high, we also get better returns on our debt type investments. So when we park money into a high interest savings account or when we park money into a bond, for instance, we're earning higher interest rates. This makes it actually more attractive for us to save money too. So it's kind of like a double-edged sword, like they worked in tandem. We want to borrow money less, and we also get rewarded for parking our money less. Overall, what that does is it makes us as consumers less inclined to go out and spend. Now, you might already be thinking in your head, well, on the other side of the coin, what happens when the opposite happens and rates are high and they start coming down? Well, what that does is it actually encourages us to take on debt. It's more attractive for us to go get that mortgage or to take out that loan or to invest in such and such business. It also makes it a lot more less desirable, more yucky to hold a bond or a high interest savings account when our yields are so low because rates have come down, pushing us more towards a consumption style attitude on a personal and general business level. Now, what the central banks do, when I say central banks, I'm talking here about the Bank of Canada, is they use these interest rates as a tool, as part of their monetary policy. They can manipulate the interest rates to help more or less guide the economy in the direction that they want it. Now, generally, they will cut, not generally, but at least, I would say generally, rates will go up or down at about 25 basis points. That's more common, is to see about a 1/4 percentage point hike or cut. Today, we obviously saw the 50 basis point cut. In fact, in a span of 5 meetings in roughly 6 months, the central bank has lowered borrowing costs by 175 basis points, becoming one of the most aggressive rate cutters amongst the central banks in major economies. With the back-to-back half-point cuts, so 2 in a row, the first time since the 2009 outside the COVID pandemic, Canada's policymakers are seeking to boost economic growth that's been weaker than expected and brace for potential tariffs on Canadian exports threatened by Donald Trump. Key takeaway from this clip is that the back-to-back 50 basis points cuts, that is a more aggressive approach. It's a more aggressive stance on lowering those rates than what we would typically or generally see, meaning that the Canadian policymakers or the central banks want to boost that economy. Now, what are some of the factors that they look at? There's all sorts of factors and all sorts of variables that come into this decision, but of course, one of the big ones that we would look at is inflation. Now, the Bank of Canada does target to keep inflation around 2%. Now, we all recall coming out of COVID not long ago when inflation started spiking through the roof. We see that indicated here with this red chart. 5, 6, 7, 8% inflation. Well, we saw rates go up, which is this blue line here, the policy rate, the interest rate, if you will. We saw that go up as one of the methods to combat this high inflation. And the logic, I hope you guys are putting the two and two together, is that again, the central banks deemed if we raise interest rates, that's one of the methods we can help stunt or cool down or alleviate some of that buying and consumption pressure, which is going to help bring inflation down. When inflation is lower and in a more manageable or reasonable range at their targets, well, they have the option of cutting rates. They can also cut rates to spur that and to kick things up and give it a little boost. Where we sit today, guys, inflation we're sitting is right around that target. Interestingly, in the US, their US inflation numbers were up, meaning people are spending and the economy is more or less chugging along. Nevertheless, of course, inflation is a big factor that they consider. Another key indicator that they look at when making these key interest rate decisions is, of course, the strength of the labor market, the job market, and the unemployment number. And in this particular instance, the November numbers were showing, the survey numbers showed unemployment rose to 6.8% here in Canada. Gross domestic product, GDP, another major factor they'd consider. Well, in this scenario, the general economic growth was a bit softer than they expected. And one more unique and I guess timely situation at play today in these decisions is the threat of tariffs being imposed on Canadian exports as Donald Trump comes into presidency. This at this point is of course still just a major unknown, but just that uncertainty in general is something that could be negative for the economy, right? These are just some of the factors. Now, I guarantee you there are many, many, many indicators more, but the case in point being as the takeaway for this video is that the central banks take in all of these different data points and variables to make the decision as to whether they're, at least looking at monetary policy, because monetary policy is just one of the tools that they have to help guide the economy. They can make the decision whether they want to support and boost the economy or more so cool down and simmer down the economy by increasing rates. Again, at the end of the day, this trickles down into everything in our lives about how we can spend and how we consume and how we invest. From a stock investing perspective, the markets do tend to like the lower rate environments. They're more favorable because businesses therefore have cheaper access to capital, therefore easier to make profits. On the contrary, however, you can make the argument that the rates are lower because they're boosting. They're trying to plump up a struggling or a slumping economy. Many ways to view it and many considerations that come into play. What I can say is that on the personal level, as a variable rate mortgage holder myself, I woke up today happy with the cuts, and I've been happy with the cuts. My mortgage broker actually sent me some fun math. For every 25 basis point decrease to the rate, that decreases your monthly payment by about $16 on every $100,000 of outstanding debt that you have. Obviously, we just witnessed a 50 basis point cut, so you could double that and then apply it to however many hundreds of thousands of dollars you have outstanding. Just, I guess, some fun math that you guys might find fascinating there. But I would love to hear your guys' thoughts down in the comment section below. There's my quick summary video. As I mentioned, guys, I have done a deeper dive on the full topic of this, but obviously this is, big relevant news. I thought I'd come make a quick video for you guys. If you enjoyed, give it a thumbs up. Let me know your thoughts. But as always, I thank you for watching. Hope you enjoyed, and I'll see you in the next video.